Imagine building the most expensive machine in human history. We're talking about billions of dollars in servers, millions of gallons of water, enough electricity to power small cities all burning every single day. Now imagine handing the keys to that machine to a startup that is losing $12 billion every quarter. That is not a hypothetical. That is the actual relationship between Microsoft and OpenAI. And right now, that relationship is falling apart in the most dramatic way possible. Today, we're going to walk through exactly how this happened, why it matters, and what it could mean for the future of artificial intelligence as we know it. Let's start from the beginning, because this story is more twisted than most people realize. A few years back, Microsoft made what looked like a genius move. They didn't just invest in OpenAI, they captured it. They handed Sam Altman's team billions of dollars. But here's the catch. Almost none of that money left Microsoft's system. Instead of writing a check, Microsoft handed OpenAI something called Azure Cloud Credits. Think of it like a gift card, but a really large one. OpenAI used those credits to rent Microsoft's own servers. And here's where it gets interesting. Microsoft legally counted every single dollar OpenAI spent on those credits as real Azure revenue growth. So Microsoft's books looked incredible. Wall Street was applauding. The stock price climbed, but the money never actually changed hands in any meaningful way. It was a loop. Microsoft funded OpenAI. OpenAI paid Microsoft. Microsoft called it revenue. On paper, it looked like a financial masterpiece. Now, Microsoft put a total of $13.8 billion into OpenAI through this structure. And the results showed up immediately on their balance sheet. Cloud revenue hit $32.9 billion. Their remaining performance obligation, which is the accounting metric that tracks guaranteed future revenue, hit a staggering $625 billion. Wall Street analysts fed that number into their models and used it to justify Microsoft's $3 trillion valuation all the way to the end of this decade. There was just one problem. About 45% of that guaranteed revenue depended on OpenAI continuing to pay its bills. And OpenAI was not going to be able to do that forever. Here's why. OpenAI is burning cash at a rate that is almost impossible to comprehend. We're talking $12 billion in losses every single quarter. Their video generation model, Sora, alone costs an estimated $15 million per day just to run. That's not startup growing pains. That is a structural financial crisis. Analysts at Deutsche Bank ran the projections and found that OpenAI would need to burn through $143 billion before turning a real profit. You read that right, $143 billion in the hole before a single dollar of actual earnings. And the entire time, Microsoft is the landlord holding the keys, waiting to get paid. Sam Altman saw this coming. He knew the Azure credit structure was a trap, so he tried to engineer an escape. He came up with what insiders called Project Stargate. The idea was massive in scale, a $500 billion plan to build completely independent data centers, bypassing Microsoft's infrastructure entirely. He was talking about 10 gigawatts of dedicated power, new facilities in Texas, and sovereign wealth fund money from the Middle East to finance the whole thing. SoftBank and Oracle were in the conversations. Construction actually started in Abilene, Texas, on a facility that would have been one of the largest AI data centers ever built. But the banks ran the numbers and said no. Private investors wouldn't touch a $500 billion bet on a company that was losing money that fast. The project quietly collapsed. OpenAI slashed their independent infrastructure plans and retreated back to Microsoft servers. They were stuck. They couldn't afford to keep renting. They couldn't afford to leave. It was a perfectly designed trap, and they walked right into it. And then the competitive landscape got even worse. Chinese AI companies arrived with a strategy that nobody fully anticipated. Instead of trying to outspend American tech giants, they used a technique called model distillation. Essentially, they bought access to OpenAI's API, fed it millions of complex questions, captured the answers, and used those outputs to train smaller and cheaper models. All without paying the enormous training costs that OpenAI absorbed. DeepSeek released their V3, 2 architecture and matched frontier American AI performance, then dropped their pricing to 28 cents per million tokens. OpenAI had been charging $1.75, Overnight, the premium model collapsed. Developers started routing 90% of their everyday workloads to cheaper alternatives and only used OpenAI for the most complex tasks. The high-margin volume that OpenAI needed to survive started vanishing. Microsoft tried to protect itself by embedding OpenAI's technology into its own product suite. Copilot became a feature inside Word, Excel, and Teams. They charged $30 per user per month. 15 million people subscribed. Sounds like a good business, right? Except here's the brutal truth that $30 monthly fee doesn't even cover the electricity cost of running those AI queries. Every time someone clicks the Copilot button, a supercomputer fires up and burns real energy. Standard software has margins close to 90% because you build it once and distribute it forever. AI doesn't work that way. Every single output costs real money in real time. Microsoft is effectively subsidizing the AI workflows of the largest corporations on Earth just to keep them inside the ecosystem. And the hardware problem is getting worse underneath all of this. Microsoft spreads its server costs over a 6-year accounting window, which makes quarterly spending look reasonable on paper. But AI hardware doesn't last 6 years in any meaningful sense. The GPUs that are cutting edge today are considered legacy hardware in about 36 months. Financial analysts have estimated there is $176 billion in hidden GPU depreciation actively decaying across the tech sector right now. The replacement bill hasn't hit the balance sheets yet. When it does, it is going to be brutal. Microsoft's capital expenditures surged 66% to $37.5 billion in a single quarter, just to keep up. They're buying land, pouring concrete, and building facilities for a theoretical demand that their biggest tenant literally cannot afford to use. Add to that the fact that Taiwan Semiconductor, which produces 90% of the world's advanced chips, has corporate demand outpacing their physical factory capacity by a factor of 3. TSMC is planning a $52 to $56 billion expansion in 2026, but even that isn't enough to close the gap. The raw materials aren't keeping up either. A single gigawatt data center needs thousands of miles of copper wiring, and mines in South America are already struggling to meet demand. Every layer of this infrastructure story leads to the same conclusion. The costs are accelerating faster than the revenue can possibly grow. Meanwhile, OpenAI tried one last Hail Mary. In January of 2026, Sam Altman flew to the United Arab Emirates and pitched an $830 billion corporate valuation to sovereign wealth funds in Abu Dhabi, asking for $50 billion in hard cash to keep the servers running. The US government shut it down almost immediately. The Committee on Foreign Investment in the United States classifies frontier AI as critical national security infrastructure. The Pentagon considers it a weapon system. Foreign capital was blocked. Every lifeline was cut. Domestic investors wouldn't cover a hole that large. OpenAI was cornered. So they did something that changed everything. In late February, OpenAI accepted a $110 billion bailout led by Amazon, Nvidia, and SoftBank. It looked like a lifeline. But buried inside the deal was a condition that Microsoft never saw coming. OpenAI agreed to route enormous amounts of compute spending directly into Amazon Web Services. They were leaving Azure. The tenant wasn't just behind on rent anymore. The tenant was moving out and signing a lease with the landlord across the street. The infinite money loop that Microsoft had so carefully constructed was officially broken. Microsoft is now sitting on billions of dollars in decaying hardware, long-term lease obligations, and a balance sheet with 45% of its future revenue projections tied to a relationship that is unraveling in real time. So where does this leave us? Microsoft's cloud growth slowed to 39% year over year in the second quarter of 2025, just below the 40% that Wall Street needs to justify that $3 trillion valuation. Profit margins are sliding. Treasury yields climbed to over 4%, which means cheap capital for expansion is gone. Every new data center now has to prove immediate profitability, something OpenAI could never guarantee. The financial model that powered one of the greatest valuation stories of the last decade is cracking. Here is the part that should really make you think. We are only at the beginning of this reckoning. The GPU depreciation wave hasn't fully hit. The water and energy constraints on new data centers are getting tighter. The AI pricing wars with Chinese competitors are still escalating. And the geopolitical barriers around funding are only growing stronger. The financial infrastructure of the AI boom was built on assumptions that are proving to be wrong, one by one.